I'm at the Cleveland Federal Reserve Bank with the president, Beth Hammack. Beth, thank you for having us here in Cleveland.
Steve, we're thrilled that you came out and made the trip.
Great. What an interesting conference you're putting on about financial stability. A good time for that, but also a good time to talk about the outlook for Fed policy. Let's start with the easy thing, which is my question about your takeaway from this morning's jobs report.
Well, we've only had a short amount of time to break down the report, and it's only just one number. Again, we don't make too much of any one individual report, and this one is a bit stale. It's a bit dated because it comes from September. It does look like it was a mixed report, but it's in line with my expectation that we would see some further softening in the jobs market, which just highlights the difficult time that this is for monetary policy, because we are seeing some signs of softening in the labor market, but we're still seeing elevated signs of inflation. And so we have to balance those two things as we're looking at our dual mandate.
Yeah, the operative phrases have been downside risk to employment and upside risk to inflation. So let me just probe a little bit further on this issue of downside risk to employment. You got a pretty robust payroll number on the one side, but the other side, kind of like the Rorschach test of this thing, which is that they had an 11 basis point increase in the unemployment rate. Does this increase your concern about downside risk to employment?
Again, it's one number,
Sure.
and we try not to make too much of any one number, and I try to round it out with a variety of other data. So the unemployment rate and this BLS payroll report is the gold standard, so it's great that we're getting this data again. But we have been complementing it with other data, whether it be the ADP jobs data, the WARN notices that we do a lot of research on here at the Cleveland Fed.
Which are layoff notices, right? Just
correct. Those are those are the large layoff notices that come out. And we are seeing that they have been moving up slightly, and so that's something we're attentive to and want to keep our eyes on. But we also really importantly spend a lot of time out in the district talking with different business leaders and hearing from them about what they're doing. I was down in Cincinnati a few months ago, earlier this month, I think, and we were talking with some business leaders there and some workers about their experiences. And what we hear from the workers is that they're holding on to their jobs for dear life if they have them. We are in this low hiring, low firing environment. But what I also heard at that same roundtable was that the money that they have coming in is just not stretching as far as it used to. That $30, what used to cost $30 now costs $50. And so they really, that inflationary pressure is still very salient for them.
How do you make determinations about what's going on the inflation side in the absence of data? We've used price stats, and without giving a long list of data, do you feel like you have a pretty good understanding of what's happening on the inflation side?
I feel like we have a good understanding of what's happening in inflation. Of course, I would love to see the official statistics because those are the gold standard, and we'll be getting those just on a delayed basis. But the information that we get from being out and talking to various businesses is really helpful. We were talking with a grocery chain in the greater Cleveland region, and they were telling us about how they're managing their prices.
Right.
They're seeing elevated pressures coming from energy prices. And they're thinking about how much of that they can pass on to their clients. Right now, what they told us is that they're seeing much more demand in products when they're offering specials, and that if they're not offering specials, people aren't coming into the store quite as much. So individuals are looking for value.
Downward pressure on inflation.
It does look like there is some softening in demand. Yeah. But in the aggregate, the data that we have on the demand side and on the spending side seems to be holding up reasonably well. So,
but you're a markets person, and I think you come from the standpoint that markets ain't stupid, which is a point of view to have. And they're not telling us very much about concern about inflation if you look at market-based inflation expectations.
Inflation expectations have been contained, which is really a good thing for us. That makes our job at the Fed much easier to do when the markets are thinking that inflation is going to stay and going to get back down to our target. But that's only one factor that we look at. I have to think about how it's impacting individuals. And when I'm out talking to workers and I'm talking to people in the district, what I hear is that the pressure from inflation is still really significant and that they're using their paychecks, much more just for food and housing and energy and gasoline costs, and they really don't have anything left over at the end of the month.
So when it comes to thinking about December, the way the minutes read was not even evenly divided. It sounded like many or even a majority of board members do not want to hike rates. Where do you put yourself in that?
I walk into every meeting with an open mind, and so we're going to continue to get information. I'm going to continue to do outreach over the next couple of weeks heading into our December meeting. But I will say what I've been saying, which is that we're at a challenging time for monetary policy. We have to balance both sides of the mandate. We are seeing some softening in the labor market, but it's in line with my expectations of what I had thought would happen. And on the prices side, we see inflation that's still too high. And some of the recent indicators that we've seen, albeit somewhat stale, have been trending in the wrong direction. And so to me, I think we need to continue to keep policy somewhat restrictive to bring inflation back down to target.
What are those indicators that you're focused on that have been going in the wrong direction?
If you look at services inflation, some of the recent prints that you've seen in core services ex housing, that's continued to go up. If you look at like a 3-month average over the past 3 months, where that's been trending upwards, not downwards.